Okay, so for question 3 in your test, this is the question that caused a lot of students to either fail or you didn't have to help you pass. Now, what was important to note in this question? If you start with the you are required to, you would see there they said journalize the adjustments for the year ended 31st of July. Okay, now when they talk about journalize, it means you have to do the general journals. When you do general journals, remember that your debit side amount should equal your credit side. Now, if you were wondering if it is a trial balance, how you should have known it's not a trial balance is the fact that they've told you no journal narrations are required. So that additional information would have led you, if you were maybe wondering which one we're busy with, that would have led you in the correct direction. Okay, so no document numbers and folio numbers were required, no closing entries. So when they talk about closing entries, that is when we transfer our income and expenses to our profit and loss and trading accounts to work out the profits at the end of the year. That was not required. You had to round it off to the nearest rand and show all your workings. This one as well, if you did not show any workings and you did a TB amount, a TB instead of a general journal, you would have pretty much got 0 for this question. Okay. Now, what was important to see here is they told you it's at the end of the year, so our year end is 31st of July. Okay, these balances are prior to any year-end adjustments. So that means they have not taken into account any accruals, prepaid expenses, any stock tags. So let's just say before accrued expenses, income received in advance, stock tax, etc. Okay, so this could be any type of adjustment that generally happens at year end has not been reflected in those amounts. What was also important to note is we use the perpetual inventory system. Now, why is that important to note? Is any inventory will go against, will be shown as an asset in that scenario, so it goes to your inventory account as opposed to your purchases account. And then they've given you an extract of your statement of financial position and your nominal account. Now, if we go through the information, they tell you the first adjustment was the depreciation must be written off for your machinery according to the straight line method. So in this scenario, we've got a straight line method which we've used, and the useful life is 5 years. Now remember, if they give you useful life, you divide the useful life. So I'm just going to say you divide useful life to get depreciation amount, and they tell you additional machinery was purchased. So that means on the 1st of July. Now that additional machinery is included in your balance on the TB above. So you have to go and remove that amount to work out the depreciation for it separately. Okay, and they tell you it was purchased for 23,000, but then they tell you it's inclusive of VAT. So that means I need to remove the VAT component to work out the depreciation for it. So let's quickly see what was the machinery value at the end of the year. It was 350,000. Okay, so I'm quickly going to share the Excel file, then we'll do the journal for that. Okay, so for the depreciation, what you had to do is you would have to debit depreciation, credit the accumulated depreciation. What was important to note is you need to state the asset name. So you have to show me it is machinery. If you only wrote there it is accumulated depreciation. You did not get the mark. Okay, so that was important. A lot of students actually missed that fact. The fact that they did not show the accumulated depreciation. Then you show the calculation. So I've now split it between the old asset and the new asset. So for the old asset, I took the 350,000. I've deducted the 20,000, which is the amount excluding VAT. Now I know that's the amount excluding VAT because I worked it out, which is the 23,000 multiply with the 100 over 115. So I take out the amount excluding VAT, which is 20,000, and then the remaining balance I divide by 5 for the old assets to work out the depreciation. And then for the new asset, I add the 20,000, divide by 5, but we've only used it for 1 month. So then I've apportioned it for 1 month, and then you get an amount of 66,333. And as you can see, the debit side and the credit side would be exactly the same. Okay, so when you do a journal entry, your debit and your credit, once that entry is done, should be the same. Otherwise, it does not balance. Okay, so let's move on to the second entry. Okay, so then for the second point, they told you that according to the physical stock take at year end, the following was on hand. So they've physically done a stock take. They tell you trading inventory is 96,000 and packaging material is 700,000. Now let's quickly see what the trading inventory amount is. So according to this, trading inventory is currently at 98,000. So that means I need to reduce the 98,000 reflected to 96,000. So I need to go show what the actual inventory should be based on my stock take that I've done. Okay, and then for the packaging material, because that is normally shown as an expense, we move it from your expense account to a consumables on hand account, which is an asset account. Similar to inventory, which we do at year end for any packaging material or stationery or whatever the case may be. We show it as an asset so that we can expense it in the following year, which it relates to. Okay, so for that one, your trading inventory, because it's currently 98,000, we will have to reduce it. So that means we would credit your trading inventory with 2,000 Rand, but then the other side would go to your cost of sales. And then for your packaging material, we would credit the packaging material and we would debit your consumables on hand to create the assets that is on hand. Okay, let's quickly read the wages and salary and the rental income, then we can do all of them at the same time. So for wages and salary, the month of July was not paid. Now, because it was not paid, it is not in your salary journal, so it means we have not shown that expense in our books, which means we need to accrue for that expense. Now, we will increase the wages and salaries expense with the 500 Rand, and then we would credit accrued expense, which is a liability in our books as well. And we will show how much we still need to pay then in the following period or the next financial period. So that's why we account for that transaction. Then the next point was rental income was 2,000 for the first 6 months. Okay. So that means for the first 6 months we paid 2,000 Rand, and then it was increased with 50%. Now, if we increased it with 50%, that means we've increased it with 1,000 Rand. So it is 2,000 Rand times 50% is 1,000 Rand. So that means our new rent would have been is 3,000 Rand for the next 6 months. Now, what you have to do with that is you have to go calculate what is the rent or rental income we should have received versus what we have in our books. Okay, so let's quickly just check what do we have in our books. We've got in our books 33,000, and when we do the calculation, we'll compare it to that to see have we received something in advance, or is there income that we still need to accrue. Okay, so if they give you information like that, you need to see whether we've paid to match or received to match, or have we not received what we should have received at that stage. Okay, so let's quickly share the Excel file to do those entries. Okay, so for the first entry, we said we are recording our trading stock. Now, the first one we said trading inventory is currently shown as 98,000, but it should only be 96,000. Now, to correct the balance, we will decrease your trading inventory with that 2,000 Rand, and then we would increase our cost of sales with that 2,000 Rand. Okay, so that is how we correct trading inventory balance based on the stock take. Now for the packaging material, because it's currently shown as an expense, we move the portion that is on hand. We take it out of your packaging materials, so we reduce it by 700 Rand, and then we create an account which is consumable stores on hand. I'm just going to say here it's an asset account, similar to trading inventory. Okay, so then we create this account, consumables on hand, to reflect the inventory for your packaging materials, which was also 700 Rand. Okay, now a lot of students did not take this to consumables on hand. They took it to trading inventory, which was incorrect because it's different types of assets. So your trading inventory is your normal inventory that you sell, where consumables stores on hand is something that we use within our business as opposed to selling it. Then the next transaction was the salaries and wages, which we need to accrue for. So we have accrued the expense already in the month, but we haven't paid it. So we debit the salary and wages to reflect the correct expense for the year, and then we credit the accrued expense to show the liability that we'll have to pay in the future. Okay, so that's salaries and wages. And then the next one was our rental income. So we said for rental income, we do the calculation. So for the first 6 months, if you take, for the first 6 months, you take the 2,000, you multiply it with 6, you get 12,000. For the second 6 months, we've increased it to 3,000, which was your 2,000 times 150%, or you could take 2,000 plus 50% gives you 3,000. So we've had 18,000. So that means we should have received for the year 30,000, but we have actually received 33,000 based on our trial balance. So that means we've received 3,000 more income for this year than we should have. So that means we've received income in advance. So that is a liability, because we need to pay it back in the event that that person does not rent it, and that means our income needs to be reduced by the portion that relates to a different year. So we reduce the rent income with 3,000 by debiting it, and then we credit the income in advance to show that if something happens today and the tenant can't use that place, we would actually repay them that amount. We would owe them that money. Then if we go back to the question, just want to finish this question, then we'll take a break. Sorry, shared the wrong thing. Okay, so then the last few transactions, okay, I see there's quite a few transactions. So let's push till 9 and then we'll take a 10-minute break and then we'll continue. Then Lemon Traders has an agreement with a local newspaper for a monthly advert insert. The agreement runs from 1 August for a 13-month period. So they tell you this agreement is for a 13-month period. So we've actually paid 1 month more than we should have. Let's quickly see our year end is 31st of July. So 1 August would have been the beginning of the year. So we've only paid 1 month to match, so that is a prepaid expense. Then we've got interest on your fixed deposit is calculated at 10% per annum, and that was initiated in the beginning of the year. So we need to work out how much interest should we have received on the fixed deposit and what is currently calculated. So if we just scroll back, our fixed deposit is 40,000. So if we take 10% of 40,000, that means we should have received interest of 4,000. Now let's quickly look at what do we currently have here. We currently only have 2,000, so that means we will have to add additional 2,000 to get to the correct interest amount. Now that means it has not been recorded on the bank side, so that would be your accrued income for your interest on fixed deposits. Then the next entry, they tell you that an outstanding balance for the debtor at the year end is 2,500 Rand. They went bankrupt, 25 cents have been received, and the remaining portion has been written off. So that means we have to go work out how much have been received and then how much is being written off. Now they tell you no entry has been made, so we have to do the full entry. And then the allowances for credit losses must be adjusted by 10% for the debtor's control balance after considering any adjustments above. So that means this adjustment for the outstanding balance, we need to take that into consideration when working out the credit losses, because the balance currently shows that 2,500. Okay, so let's then look at how you would do the entries. Okay, so the first entry would be the prepaid expense. We said it's 3,000 Rand. Now you could have done it as follow. You could have done the 3,900. So that is the 300 times the 13 months, and then deduct what it would have been for 12 months, would have given you the 300 Rand that it is paid in advance, or the prepaid expense. Okay, then the next entry would have been the accrued income. Now we said how we calculated that was the 40,000 times the 10%. So we should have received interest income of 4,000 Rand. We've only accounted for 2,000 at this stage, which means we need to account for the additional 2,000 to reflect the correct income we should receive during the year. And that is taken to accrued income account, which is an asset account, which means the bank will have to pay it to us in the future. Then the next entry was the bad debts written off, or the insolvent debtor. Now you could have done this as one entry or two entries. We marked both. So for the bank, you take the 2,500, you multiply with the 25% to work out we will receive 625 Rand. For the credit losses, you could have then taken the 2,500 times with 75% to work out the portion, or you could have taken the 2,500 and just deducted the 625, and then you reduce your debtors control with the 2,500 to show that we will no longer actually receive any money from that debtor. But then for our credit allowances, which was the last entry, you would have to take the balance as was, which was the 45,000 in your trial balance, and then you deduct the 625 and the 1,875 from it, or the 2,500, and you multiply it with 10% to give you a balance of what it should be of 4250. Currently, it is 3,500 on your balance sheet, so that means we would increase the credit allowance for credit losses with 750, and then we would put an adjustment through in our trial balance as well, in our nominal accounts, which we call allowance for credit losses adjustment of 750 Rand. Okay, so that is question 3. Do you guys have any questions on that?